It's December 31st, 2021. 2021 at this point is basically in the record books. And I wanted to take a look and see which asset classes have done absolutely well and kicked ass over the last year, and which ones have kind of fizzled a little bit. So to do this, I opened up this spreadsheet I have that I use to track 13 different asset classes in my global momentum strategy here, and gone ahead and sorted them by 12-month return. Interestingly, at the top, we've got US Reits as represented by Schwab's REIT ETF, SCHH, with a 12-month return of 39.58%, absolutely killing it there. And then down at the bottom, BWX, International Treasury Bonds, down almost 10% on the year. And then there's S&P 500, which a plain old S&P 500 index fund has returned about 27 to 28%, 27.32%. By the 12-month return here, as it is at 353 on 12/31. So these are the numbers here. Let's do something different, or let's leave this table data and make it into a chart. And we'll expand that chart up. Now these ones down here are not part of the 13 asset classes that I regularly track. This is S&P 500, that's 2x S&P 500, and that's SPXL 3x S&P 500. Anyways, let's kind of look over here and kind of go down the line. REITs and then commodities being second. Now, commodities and REITs are two asset classes that typically do well during inflation. There's no rule that says they have to do well, but they typically do well during inflation, and this year they have. Following that, we've got small value at 28.24%, and then large growth. Now, that is very odd. I don't like the word odd because that implies, well, that it's odd, but it's uncommon to see those two having very similar returns over a period of time, because typically within the asset classes of US equities, large growth and small value are going to be the two most uncorrelated assets in there. But here they are side by side, returning basically the same. Then I'd guess it's going to be US equities rounding it out up here, large value, small growth, and then finally international equities. So this is like EFA. Emerging markets is in here. Where's emerging markets? There's corporate bonds, intermediate treasuries. There's emerging markets down 3.13% on the 12-month. And then finally, 12-year treasury bonds getting absolutely crushed. Gold, gold not doing well at all. I kind of laugh because gold is one of those assets that's like supposed to be inflation protected, right? That's kind of the cliche, age-old advice. You want to protect against protect against inflation? Invest in gold, buy gold. Well, here in this past year, in this inflationary regime, it's gone down. It's been worse than cash. You'd be better off holding cash than holding gold here. And I've looked at this. Really, the only time that gold actually held up as an inflation-protecting asset was in the 70s. But in periods of inflation beyond that, gold has actually done very poorly. So it's kind of a myth, kind of a wives' tale that gold is an inflation protection. And then finally, international treasury bonds. I really don't know much about international treasury bonds other than they are in this strategy. So yeah, REITs, commodities, and small value. I was going to say large growth. REITs, commodities, and small value is where you wanted to have your money at in 2021. And then interestingly enough here, we've got S&P 500, 2x S&P 500, 3x S&P 500. Now, what stands really interesting to me about this is the decay associated with these leveraged ETFs. And this is a whole nother topic, but as a general rule of thumb, levered ETFs suffer from decay due to daily resetting. But as you can see here, that's not necessarily the case during strong bull markets. Here we had the S&P 500 at 27.32%, while the 2x version of it was up at 61.01. So it returned more than 2x. And this right here at 99.81%. If we take that, what is that, 27.32 that I have on the S&P 500 there? I mean, if you take it, well, I think I did the math. 27.32 times 3 is only 81.96, while 3x S&P 500 has returned 99.81. So I guess what I'm saying is maybe you should just go 3x S&P 500 next year? No, don't do that. That probably would not be a wise idea, at least not with a strategy behind it. I'm certainly not promoting that as advice. Yes, it's nice to look at the S&P 500 and, damn, I look back, I'm like, why didn't I just go all in S&P 500 3x? Well, fundamentally because the risk-reward profile is not all there. We had an anomaly of a year with this kind of return from S&P 500 levered. So on that note, guys, how did you do in 2021? What kicked ass in your portfolio? Let me know in the comments below.